Okay, our uranium update, September 27th. This is Tuesday, so we've had two trading days to kind of understand. Are we going to get follow through on the Monday candle? Are we going to get consolidation, or are we going to get a reversal? And the Monday candle was actually inside, so it wasn't very decisive. But what we do have is a swing low, and I posted this on Twitter. As always, take a look at the links in the description. You can find my Twitter there. I post more real time. Also have links to the previous uranium update, broader market update. That's a really important one because basically where the broader market goes is likely where uranium goes. I mean, maybe it decouples, but that is definitely taking a risk. So take a look at that. And also Cycles 101. I'm assuming you understand how cycles work. Although in this case, cycles are a little bit less important, and we'll talk about that. At least the shorter term ones. The longer term cycle, definitely always important to be aware of. So, as I posted on Twitter, it looks like we may so here's what I'll say. We do have a swing low for sure. That's just math. Once we cross above this high here at what is that, 26.35, that's a swing low, right? So we closed at 26.42 and we were even a little bit higher than that. We kind of did, so that's actually a great question. Did we close that gap? I think we did, actually. That's important to know about. That's really important to know about. So that's not a good sign. So now look at the structure of this chart. That's important, and you'll see why that is so important. So actually, let's flash back to this one. So that's like barely a gap. Barely a gap. Well, actually, to where it opened, it certainly is more of a gap. So let me tell you what I mean by this. So this candle, well, I guess let's look at it close to close, right? So this candle closed at, so this is your September 15th candle. This is the point is this pattern, right? So your September 15th candle closed at 28.90. It had a low at 28.55. And so it depends on how you think about the gap. If you think about the gap from close to open, right? So where did it close the previous day and where did it open the next day? That's actually, the gap is from 28.90 to the open of this was 28.27. So it's like a 60-cent gap, not insignificant, right? And so we gapped down that day, but we didn't have a ton of downside like follow through, and we even rallied later in the day. And then the next day, we had a pretty strong rally. So this isn't like, you can tell, like the next day opened here and we closed here. So like it was actually a gap down opening as well that got filled for the most part. I mean, if you think about it from close to open, again, that's a more sort of nuanced way to think about it. And then we actually got follow through that next day, made a higher high above this one. And this one actually was a bullish outside day, right? So it made a new low and then it made a new high. And then we got follow through and we actually closed the gap. That's really important. We closed the gap with that follow through. I hope you're seeing that. Like that 60-cent gap, this closed it. But then what happened the next day? We got rejection and we got 3 down days. And this has created another gap. Now, this is the gap from the low, but you can also think about it as your gap from the close. It's like the same pattern, right? So, like we had a day that, well, in that case, that was a bullish outside day, so it was eventful. But we had a day in between, and then we did get upside, and we almost closed the gap. And so now we're going to have to watch this closely. This could be telling us that like this area could become something of a ceiling, right? And more importantly, we have this gap below that so far we're actually holding above, and that is bullish. But the longer we stay in this area, the more likely we do fall below the gap. It's kind of an important way to kind of think about it. It's almost like you're either moving violently in one direction or the other. If you just kind of stay there and consolidate, then this becomes basically a bear flag and it's vulnerable to failure. So that's your daily. That gap is the thing. This gap is the thing to watch, like below. And if you think about the weekly chart, I've been adding this 200-week moving average. I'm not saying we get down there by any means. I mean, you can see we've stayed comfortably above that for this whole period after we came rocketing out of it like November 2020, right? And just making higher lows. So, and that would be, and at this point, the 200-week moving average is well below 16, and we're up here at 26. So that would be a massive drop. Now, because it's the 3-year cycle top, most likely, right? Like here, right? Like this is clearly, you can draw the line however you want. Like this is clearly sloping down, right? So this is your potential 3-year cycle top here. So you can see a world where we don't need to get a ton of downside in terms of price, but we can just kind of meander lower here for the next 6 months, and price basically the 200-week moving average catches up to price, right? Like it just like they meet somewhere in the middle kind of thing, and we finally get our test of that level, like 3, 4, 5 months later. Because I could see a world where uranium is going to hold up better than the market. I mean, case in point, look at this weekly candle. Now, this is important, these details, so that you're like really understanding the price action. It's an inside weekly candle. We haven't made a new low and we haven't made a new high. It's just a big nothing burger. But it is green. That's important. The other indices, other sectors are most assuredly not green on the week. They're red, right? They may not be showing massive downside follow through, but they are red and this is green. And so again, this will probably outperform the market, but I think it's going to be hard for it not to get dragged down by the market. And if you look at the monthly chart, this red candle, and then now you have this other red candle, that's a lower high to this. So not quite a double top, really truly a lower high. This is week 30. And this still, as 3-year cycle lows go, this could still be like a relatively mild one in terms of price decline, even if it's kind of frustrating in terms of time. Like you could see a world, like if you look at the monthly chart, you really look at this closely. As long as we stay above the $20 area, we're probably fine. And obviously that's a decent amount of downside from here, but like it's not catastrophic, right? Like you can imagine a world where we kind of meander around this 20 area, right? And then we finally make a move higher at some point once we hit that, 3-year cycle low. But you could see a world where it's not like a rapid move lower, but just kind of a meander. I mean, if we look at some of the other uranium names, just to kind of get a smattering, it's all the same kind of thing, but I know folks are often curious about other individual names. So yeah, they're all solidly red. That is SMH. That's not intentional. This is obviously taking a little bit of time to load, but you can see kind of Denison in this lower left-hand corner here, solidly red month. UEC, same thing. For the URA uranium sort of ETF itself, also not looking so great, red on the month. Yeah, they're all red on the month, which is absolutely what we expected. If anything, you sometimes maybe have one that's bucking the trend. In this case, none of them are. And none of them have quite made new lows on the month yet. Well, GoviX is GoviX has made a new low on the month. So suspect there is more downside as they get dragged down by the market. You can see Paladin, which was probably one of the more bullish ones. Red shooter on the monthly, just all not looking great. So patience is required here, really, folks. It's all about patience. Again, thinking about how uranium might outperform the broader market. To me, I think it's important to consider cash as a position in this bear market, right? That's okay. It gives you optionality. I don't think there's any rush. Most assets are moving into a 3-year cycle low. The dollar is moving into a 3-year cycle high. Let's just let it play out.